Walker, I'm literally so confused. You just said in your last video that laundromats and car washes aren't businesses, they're actually real estate. And you talk about buying businesses, and I've heard about buying laundromats and car washes as sort of a entry-level business to acquire. I'm going to set that straight today. We're going to give you a framework for uncovering how to think about different business profiles in terms of looking at them for acquisition. My name is Walker Deibel. I am the Wall Street Journal bestselling author of Buy Then Build and creator of the Acquisition Lab. I've been doing acquisitions for 20 years. 20 years this May. I started my first business search. I've done almost 300 transactions or consulted on over 300 transactions, but a number of companies on my own. And today I want to go back to sort of the fundamentals. In Buy Then Build, I don't remember what chapter, early in the book, we talk about the AE matrix, okay? And the AE matrix is sort of constructed of two things. One, I have an MBA, so everyone who has an MBA has to have a 4-quadrant matrix in their book. But more realistically, it's because as we look at businesses and we're thinking about trying to acquire them, we're trying to figure out what is the upside, what is the risk, all of these types of things in order to make one of the most important financial decisions of our entire life, right? All of us know that, I hope you know that owning a small business is the single fastest way for most people to build generational wealth, right? But it's not a diversified strategy. It's something where you kind of go all in and throw yourself in on it, unless you're going after a portfolio strategy or whatever, different video. But the point is the AE matrix, just like stocks in the stock market, okay? There's sort of this growth, axis, and then there's this sort of value axis that's under, sorry, value. And the point is value growth. The point is stocks have, am I investing in value stocks? Am I investing in growth stocks, et cetera, et cetera? It's sort of the same concept. How I came up with this. I'm going to switch to green because green means money. Okay, the lowest value, lowest growth is what I call eternally profitable, okay? Eternally profitable businesses, okay? And the thing with eternally profitable businesses is these tend to be cash cows, right? They tend to have very small upside opportunity, very small threat of industry disruption. There's not a bunch of technology moving in here. They're stable, they're dependable. Usually the customers have been there a very long time. And as long as the service is good, they're very unlikely to switch, right? So that in turn eliminates sort of the threat to new entrants, right? So this is sort of is close to a passive investment that we get into here, right? And so I think the underlying concept that I was talking about in the last video is the fact that, I call this acquisition entrepreneurship because there's nothing passive about entrepreneurship. There's something passive about investing. And, AE or ETA tends to be sort of the intersection of being an investor and being an entrepreneur and looking for, how do I live the most engaged life possible by buying a business rather than starting from scratch and sort of leveraging these revenue, customers, infrastructure, and profits that have existed sometimes for decades before I've even shown up, right? That's the fundamental theory. And so, looking at these eternally profitable businesses, this is where your laundromats are going to be. Your car washes technically are real estate because they even trade on cap rates rather than multiples of earnings. But let's not get all hung up there. I mean, examples are laundromats, there's snow removal, landscaping, window washing, plumbing and electric, all the home services, boat docks, okay? Preschools, I own a number of pre-K schools in the Midwest that the kids, there's a consistent demand for, high quality, pre-kindergarten education. This is that eternally profitable sort of segment, okay? And that's how you kind of think about this. The concept, just to reiterate once again, it's more dependable, it's more stable. But if you're buying something that just has consistent cash flow with no real upside opportunity, what would you expect to pay for that, right? And so it's something where a lot of the, in contrast to some of these other options, a lot of the value can be extracted just because it's so dependable, right? And that's sort of a valuation point. point, but then you get the turnaround over here, okay? Turnaround. And the point here with the turnaround is that, this green isn't working, I'm gonna switch it out. The point here with the turnaround is that this is the fixer-upper of business acquisition, right? I mean, the best opportunities in the turnaround segment are actually in like really bad shape, okay? Like these are companies that sometimes are bankrupt, okay? And you're simply buying them, on book value. There's no multiple of earnings. A lot of times there are no earnings. And so you sort of have to go to the balance sheet and be like, right, what's the book value of this business? What is the sort of like infrastructure made of, right? And, or liquidation value could be another word for that. But it basically requires, in order to do this, there's more value here, but you need to understand, like this is an advanced segment, okay? A lot of people are like, oh, I want to find a great business with no risk that's just like continuing to go. Well, yeah, it's your first one. But other people are like, oh, I want to find businesses that are super cheap and I'm going to wait for the recession and all this other stuff. I've been through 2 or 3 recessions doing this, and I will tell you that everyone is skittish right here. It sounds great on paper, but people don't actually catch falling knives and plan to make a lot of money. So, but it can be done, okay? The concept here is that you're able to build efficiencies, strengthen the value, come in with leadership, manage the team, really tighten the belts, build an entrepreneurial culture, and ultimately turn this thing around and build something of tremendous value at a very low cost, okay? So the risk here, I believe that this real estate adage of you make money when on the buy has sort of been wrongly applied to acquisitions and entrepreneurship. I think it really is about you make money on the sell and like what you can do for it, because the multiples are so low to begin with, right? You're paying 3 times earnings or whatever. This isn't cap rates. The cap rate on these things would be like 30-35%. It's crazy, right? So it's all about your ability to execute, except on a turnaround, okay? The risk is that you overpay and you go out of business. And so this is where you make money on the buy. This is the segment where that is actually true, okay? The rest of these, not as much. Up here, you've got high growth, okay? And the concept here is that, high growth. The concept here is that the fundamental drivers of value in any business are revenue and earnings and the growth of them, okay? And so when you look at any business and any business that ends up having a really high demand or being able to fetch a kind of, high value, higher than average valuation in the market, usually has some form of growth happening. And I like to say it's because we know for sure that whatever happened in the past is going to happen in the future. That's a joke. It will be in all capital letters that that's not true, but this is yet still how we make decisions and measure value on things, right? So whenever you've got, businesses growing at over, 20% year over year for a series of years, you've got, I think it's, if you started over $1 million and you grow it over 20% for 5 years or more, you've got one of the most valuable companies in the world, right? Vern Harnish calls them gazelles. And so the thing is those are going to be companies that drive the most value, okay? And because you're having to pay a higher valuation or a higher multiple of earnings for these types of businesses, it's all about making sure that you keep whatever those value drivers are, you need to keep them in place. This is not where you jump in and start changing things. This is like, okay, I'm going to catch this wave and I'm going to continue to ride it as high as I can. And I don't want to get into net present value of discounted cash flows and all the rest of it, but that is ultimately how the value on these things is figured out. And so all of these have like multiples attached to earnings in order to acquire them. And here though is more about, it's going to be higher. And so the risk is all about, if you get off the wave prematurely, your cost of capital, your cost of capital is too high. To do anything different. Okay, so you always just want to make sure that whatever it is you bring to the table, you're able to keep that in place, okay, with the existing management team or whatever it is, okay? The last one is platform, okay? And the platform business, all right, is one of these where I borrowed it from private equity, okay? But in private equity, a platform business is one that is the first acquisition in some kind of vertical, and they're planning on decreasing expenses, increasing efficiencies, and hopefully growing the top line a little bit to extract value out of it, pay down some debt, and then sell the thing. Or sorry, because it's a platform business, they're buying multiple businesses in this vertical, and they're using that first one as the fundamental, as the foundation for growing through acquisition. Okay, which is a super powerful strategy. In the AE matrix, I actually use it slightly different. I believe that this is your platform as the entrepreneur, as the operator of this business. Okay, even if you're a passive owner and you put a manager in place, like you still have a je ne sais quoi if you're buying a platform company. The concept here is pretty easy. You want something that with a higher upside. As an entrepreneur, you want something that has a higher upside than an eternally profitable business, usually, okay? High growth, you better be doing exactly what you're doing, and the risk comes in by the high valuations that these companies drive. The turnaround, the risk comes in because it's a plane flying really low to the ground, and you've got to get it back up, and that's a hard effort. A platform business is just finding that one business that's really valued at, fair market value, okay? And you can pay the seller a fair price, and they're super happy and you're super happy. But the thing is that whatever it is that you bring to the table, whether that be, sales management, sales ability, consumer marketing, operations, quality assurance, financial engineering, whatever it might be, having an edge in a specific industry, all of these things will make that business a platform for you, right? To come in and actually make an impact, and you become the driver for the increase in value in a platform company. Okay, so again, just covering the fundamentals. This is the AE matrix. It's in Buy Then Build. If you're trying to figure out, hey, which one of these do I go into, or how do I figure out, what I do, pick up a copy that's like $20 or something. It took me 4.5 years to write. It's it'll walk you through the prep funnel and all the rest of it. If you are currently on your journey, we started Acquisition Lab as the elite provider of an accelerator to help people find and buy businesses. It's the only do-it-with-you buy-side advisory firm out there. We run in small cohorts. We have a very vetted community, anchor in world-class education. We've got like 6 coaching calls a week. I run the search forum every other week where we go deep into your deal, and all the tools, resources, supplier network, and all the rest of it. Hope to see you on the inside. Thanks so much.